Hello everyone, welcome to the Grow Your Future podcast. This is the Money Club series. My name is Zah Azmi, your host, and I'm joined by the man, Sam Eljerban.
How you doing, Zah?
I'm great, mate. How are you? Welcome back.
Thank you. It's been a couple of weeks since we last did one of those.
I know, where have you been?
I've been busy, mate. Busy.
Tax returns? Tax returns?
I say this every time I'm on, it sounds like I'm always busy. I'm always busy. Yeah. I'm that busy. I was unable to get a haircut.
Wow.
And when you have a beard like this, it's sort of paramount, especially when you're dealing with clients.
Yep.
To look sharp, and it's not been happening. So
wow.
Clients have been coming. Yeah, clients have been coming,
so
expecting a tax agent.
Yeah.
And seeing a Taliban fighter. So it's been interesting.
So it's tax time. That's why you're busy, right? So let's explain to our listeners why you're so busy right now, and it's timely because the topic we're talking about today is tax.
Tax.
Now, for our listeners and our viewers, we don't want you to get bored out, and we won't make this podcast too boring for you. But it's an important subject. We need to talk about it because it applies to everyone, right? Tax is one of the biggest expenses that anyone has. I believe it is.
Yeah.
Right.
Yeah.
It is. If you're any law-abiding citizen, like, everyone pays tax. So it's funny because every time we talk about tax, most people run and hide. It may be because it's too intimidating, too overwhelming. It could be because it's too boring, because I sometimes find it quite boring, especially when I talk to you. So look, but it is important to get your head around it. So we want to talk about tax today and how we can minimize it, right? And also, you know, what it is exactly, right? Why do we pay so much tax?
Yeah. Okay. So tax, I guess, is one of those things that you have to be a part of, right? Like, what's that saying? Death and taxes are the only things you're certain you're going to cop in your life. So, tax, unfortunately, is a very big expense, and I don't think a lot of listeners know, but tax is pretty much involved in every single transaction you make. Really, we get a lot of focus on income tax, which is what we're going to talk about in more detail down the track and today. But even when you go and fill up the car with petrol, right, there's taxes on that. Even though you're not paying them directly, there's a tax on that. There's a tax on a luxury car when you go and buy a car, right? There's a lot of tax. There's land taxes if we're talking about property. There's taxes everywhere. And a lot of them you have not much control over because they're inherent in that expense, right? The key difference between those taxes and the taxes that we're going to look at, income taxes, is that in Australia, it's a self-assessed system, meaning we, and by virtue of using us at the Money Club, have the ability to determine your own tax liability. So there's a lot of power in that. A lot of countries don't have that ability. My brother's in Norway, Said, right? Said goes to work, comes home, makes his money, whatever that may be. He has no ability to do a tax return at the end of the financial year. So the tax is already taken from his pay, and he has no discretion, no ability to help reduce it at all.
So there's no tax breaks?
There's no tax breaks.
Wow.
So as an income earner over there, they withhold the tax on his income, like they do here.
And what's the percentage over there, Sam?
I don't know. I don't know the tax system over there too much, but
it's probably not as high though.
Probably not as high, but the key thing I'm trying to drive here is that this income tax component of taxes that we're dealing with as a whole, you have an ability to change and to get as much money back as you can from it. So even though people don't like to look at it, just like budgeting, like we touched on before, it's a key thing that a lot of people don't want. It's a taboo thing. Tax can be a taboo thing.
Well, it's money that's getting taken from their pay packet.
They should be concerned. You should be concerned, not concerned, but aware about it. And just go, okay, if I'm getting taken that much from me, what should I do about it to try and get more in my pocket?
Right. All right. So let's really simplify it, right? For the listeners who have no idea about tax, and you know, we all need to understand at least a basic understanding of what happens with your pay packet or what happens with your tax return, all of that sort of thing, and how much actually goes to the government. And the best way I like to look at it is, let's refer it to food, right? I love referring to food, right? So let's say you got a pizza. You got this pizza that we all know has 8 slices, right? Just think about it, Domino's, large, pepperoni pizza. Pepperoni pizza, right? With extra cheese. 8 slices. Now, Imagine if you got that pizza, you went to Domino's, but you didn't get 8 slices. Yeah. You got 5. 3 slices have been taken out, and you got 5 slices. Would you blow up? I'd blow up.
Oh, yeah.
Right? I go, what is this? That's basically what happens with tax.
That's right.
So you go to work, right? And you can even look at it as you go to work Monday to Saturday, and Monday and Tuesday is free, right? You're actually working for free. You're working for the government Monday to Tuesday. So we need to figure out a way, how do we claw some of that tax back? Because the tax codes are there.
Yeah.
The tax codes are being given to us to be able to go, okay, what breaks can we get? Could it be through depreciation? Could it be through expenses? Or what is it? What can we claim, right? And I think first of all, we need to sort of advise that this is not taxation advice.
Oh, that's a good point.
Right? So we need to, say that, if you guys are looking for actual financial and tax advice, to go and get proper and professional advice from an accountant, financial advisor, all of that sort of thing, which we can help with.
100%.
Right? But this podcast is general advice only.
We'll discuss tax in a general sense.
That's right.
I guess, okay. So one thing, looking at trying to get as much back as you can, that comes about when we're talking about individuals and workers, right? A lot of the people listening, a lot of people will be in business, but I think a majority of people will be an individual taxpayer, meaning they receive a wage, right?
So an employee.
An employee. And so with the tax system and how it operates, as an employee, you get a wage. And like you said, the government takes that 3 slices of pizza, right? Or the tax withheld. So you have no control over that. It just gets taken. And you have to wait until the end of the financial year to try and claw some of that back. And I guess when you have a tax person in your corner, helping you, guiding you throughout that financial year, they can give you strategies on how to get as much back as you can. And there are tricks like depreciation and things like that to get that back. So there's many avenues to try and claw that back, mainly through, they have limited the scope of those clawbacks over time. The ATO and the government have been quite, what's the word? They've put a strict control on how creative you can be. So it's really limited the amount of deductions you're able to claim. And it has steered a lot of people into property, because negative gearing is one of the main things that you're able to utilize to try and reduce your tax.
Okay, so let's take it back a step, Sam, right? Let's talk about, okay, we've talked about the pizza. Yeah. We've talked about the Monday to Friday work, and Monday and Tuesday are basically working for our mate Scotty Morrison, right? So what we want to do now is go, okay, let's actually talk about figures. Now, the average income for our listeners would say be 100 grand, maybe?
I looked it up. I actually looked it up.
What is that?
ABS.
Yep.
Australian Bureau of Statistics said the average income for an individual is about 87 grand, 90 grand. So close.
Let's call it 100 grand, right? Because our listeners are, they're trying to grow their futures. They're above average, right? And they're actually working to be, in the hundreds, several hundreds of thousands of dollars per year. So at $100,000, they're going to be taxed at around, 35%, something like that. All right. So 35 grand of that 100 grand.
Let's say 30. Say 30.
30 grand of that 100 grand is getting paid straight to tax. So that gives our listeners a good idea of how much tax is paid on the average income. Now, for our listeners who are earning above, say, 180 grand, which we want all of our listeners to earn above that, because 180 grand isn't even that much money, right? They're getting taxed half, right? So if you make $200,000, 100 grand, bang, goes to the ATO. Now we got to figure out a way.
A little bit different, just to clarify the figure. Yeah. So 200 grand, the 200 grand, only the 20 grand above the 180 is taxed at the 50% mark.
Above the 180.
Yeah. So it's still going to be a high amount of tax, but not 100.
Okay, sweet.
Sorry, just to clarify.
That's okay. But
a lot of tax.
A lot of tax. So let's say, some of our listeners are working towards a $500,000, $600,000, $700,000 income, then it's almost basically half that's going away.
Once you get to those levels, it's going to be big money.
So let's go back to the $100,000 one, which is 30 grand, because it's just an easy example for us to sort of work off, right? Now we've paid $30,000 to the ATO. We need to now figure out a way, how do we claw some of that back, right? How do we get some of those slices of pizza back? How do we get some of those days back where when we go to work, we know we're getting paid for it? You guys are already paying that tax, right? It's already been done. You can't get around it. Right? Legally, you have to pay that tax.
Not even legally, they just take it off you straight away.
That's right.
They're paying themselves first.
They're paying themselves first. So what do? How do we get some of that back? We need to understand this. And also, maybe it's a good driving force for you guys to go and start your own business. Because when you start your business and you set up a company, for example, right, your tax rate or tax bracket is actually lower than an employee.
It can drop. So I guess there's two things that are good about moving away from an employee type situation to a business. One is that pre-tax from an employee's point of view. I go to work, I make salary, ATO takes cut of that straight away. When you're in business, like you know, you make the money and pay the tax at the end of the year. So you have a lot more cash flow to play with, right? So that's the first thing. Second thing are the tax rates. Tax rates, like you mentioned, are a lot more favourable towards business. I think in Australia, the whole idea around the tax system is really to help entrepreneurs, really to help investors, and not just a worker. They maybe a skeptical point of view, but they don't seem to try and help the worker as much. They really want to drive investment and entrepreneurship, and they show that through the tax system as well. So moving to an entity or trading as a business, and if you're in a company structure, the tax rate can be a lot lower than that higher tax level. So if you are in a profession or in a job that you could potentially set up a business in, there could be merit in doing that. There are risks, of course, going into business, but from a tax point of view, that's a way to try and eliminate or be a lot more flexible with the amount of tax you're paying.
Let me stop you right there, Sam. Let's talk about the skeptical view of why the government or the ATO gifts those entrepreneurs, gifts those self-employed people with better tax breaks to enable to claw a lot more back than employees. Now, I believe that's been done because essentially entrepreneurs drive the economy.
100%.
Right? They provide employment to those workers. They build housing, you know, as property investors, because the government doesn't want to build houses. They don't want to fund it. They don't have enough money, right? So what they do is they get property investors like us to go and develop housing, provide housing, and they give us those almost like a gift, a reward for being able to do that. So for example, you know, we can build a $1 million, 5-bedroom home, and if we use that as an investment, we can claw back about $40,000 worth of depreciation in the first year. So that's massive.
Huge.
You know, if you've got 4 of them, that's $160,000 in the first year that you can claim as a loss.
And if you're on a 200K income, right, you got no income, you get a full tax rate.
You're paying no tax, right? You're paying no tax, and this is essentially how the rich pay no tax. So, you know, if you're an employee and you're thinking, oh man, I'm paying a lot of tax here, I would really consider moving over to become self-employed or a business owner or an investor, right? Because that's where the lowest tax is being paid.
100%. So yeah, the tax system is set up that way. Workers, are taxed very high. So like you said, the highest marginal tax rate is 47 cents. If you're earning over 180K, every dollar you're earning, 50% is going to the government.
Wow.
So it's not even Monday, Tuesday, it's Monday, Tuesday, and half of Wednesday you're working just to pay. So
2.5 days you're working based essentially for free.
That's right. And if you're in another structure, just say you're a business operating in the same way, it's going to be 27.5. So I don't know what that in days, just say 1 day, 1.5 days. Yeah. So if you can compare that, that's a big saving.
Okay, so it's not all doom and gloom for employees, right? Yes, being a business owner has its advantages, but like you said earlier, Sam, there are plenty of risks there as well, right? Like there's a lot of like I own several businesses, and if I don't make money, I don't eat, right? So, there are benefits of being an employee because you do get that stable income. So, and a lot of our listeners, they enjoy being employees, right? Like I miss being an employee.
It's very safe.
It's very safe, it's very secure, and you know what you're getting, right? What can we do though to really claw back some of this tax that we're paying first, right? How do we, I guess, what are the deductions that we can make, you know? And without going to super fine detail, what are the like sort of the bigger picture things we can focus on?
So apart from business, so going to business is the best thing, probably to help reduce. I tell a lot of clients that. But if you're not and you're an employee, like I said, the ATO and the government have really cut back what you can claim. You used to be able to claim a lot of stuff, medical expenses. You used to be able to claim expenses for school kids, computers, things like that. The ATO have really pulled it back. Really now, when I'm dealing with clients, a lot of the time you're stuck at claiming anything to do with your job. So that's equipment, things like that. Even then, there's a comparison between business and employee, because a business can write things off and claim a full amount, where an employee has to depreciate certain things. So there's limited scope on deductions. So really, an employee, you're looking at anything to do with work. Super is another thing. Super deduction is one of the main things, and I like super when dealing with employees because it's merely a transfer of wealth. You're going from your name to super's name, and you're going to make a tax deduction for that.
Is that called salary sacrificing?
It can be. So you can do a salary sacrifice. That's where the payroll officer will take more of your wage and put it to super and reduce your income. You can do other ways as well, though.
I actually love that. Right, because you're basically
paying yourself.
Yeah, you're paying yourself first, right? And what I like about that, it's before the government takes the tax, right? So when you get your pay packet every week or every month or every fortnight, the tax has already been paid out of it. So we call that after-tax dollars that hits your account, right? But with this salary sacrificing or these voluntary super contributions, what happens is that you get to control your wage pre-tax. So before the government has even touched it. Now that means that you're actually getting a really good, it's the most tax effective strategy really, right?
And it's a very simple one. And like I was saying, it's merely a transfer of wealth. You're saying, okay, instead of the 10 grand coming to my name now, I'll put it to super and get a tax deduction for it. So we'll take the 100K, for example, just to give a working example. You're on 100K, you're paying 30 grand tax, say. That 10 grand, so you're already getting super as part of your salary, right? You're already getting 9.5%. So you're already getting 10 grand on that 100K going to super. There's a cap. This isn't advice. It's not financial advice. I can't talk too much about super, but anyway. That 10 grand going to super already part of your salary package. Now, if I was to advise a client, I would say you've got a 25K cap that you can contribute to super as a tax deduction. 10 grand has already been utilized of the 25 through the salary. You have a potential $15,000 left that you can contribute through salary sacrifice. If he was to do that, that 100K would then come down to 85, and he'll be taxed on 85 when it comes to the tax return. That 15 grand would go to super. There's a small tax paid when it goes to super, but it's a lot lower than the marginal tax rate he's on in his individual name. And the 15 grand transfer to there, that deduction, you're probably going to save about 5 grand in tax, 3 to 5 grand. So purely by paying yourself first, by virtue of transferring to super, you're going to save about 5 grand.
Okay, so let's just break that down, because Sam's Sam's example would have wigged a lot of people out, and we would have lost a few people. So basically, what we want to do is we want to transfer those funds before you get them, right? And what happens is that the government just rewards you for that.
Pretty much.
So you get a really big tax break for it. You lower your taxable income, meaning more money in your pocket, right? And why don't more people do it? Because they don't know.
They don't know.
They don't know.
Because they don't talk to people.
They don't talk to people like us, right? And also, the government puts all these regulations in where we can't give advice because you're all going to sue us and all of that sort of stuff. And now, you're like, people are just confused. Right? 100%. So what we advise you guys to do is get the financial advice, right? Get proper professional advice so you know that what are your rights, what can you do legally.
Just options.
Yeah.
You're just looking for options.
You know, one thing I want to talk about, Sam, is a tax variation.
Oh, yep.
So many people don't know about this. And to be honest with you, I only found out about this a couple of years ago. And I advise everyone to do it. So can you explain to us what is a tax variation?
Tax variation. So a tax variation, it mainly applies to employees. So guys earning the income, tax withhold straight away. It really applies to people that are getting a tax refund at the end of the year. They know they're going to get a tax refund, mainly because they have deductions coming through that they know they're going to have.
So such as like maybe an investment property. Yep.
So if someone has a property portfolio, even one, and they can project the income and expenses with depreciation and realize a loss, what they can do is contact a tax agent, us if you want, and what they can do is submit a form to the ATO saying, okay, I'm on 100 grand, my tax withheld is 25, 30 grand, whatever it is, but I have an investment property, and by virtue of those numbers that we're projecting, I'm going to have a loss of 20 grand because of depreciation and other things. I want my payroll officer to, instead of withholding tax at 100, I want them to withhold it at 80. So what you're doing is you're able to get your end of year tax refund through your pay slips straight away. So you're going to have a higher net pay. Why that's good is that you're getting paid first instead of waiting another year to get that money. And two, it's going to help with your cash flow. As we know, property investors, cash flow can become an issue, and you really want that money in your pocket rather than the ATOs. So tax variation is very key for property investors. If you have property and you don't have one, and you're realizing big losses, maybe you're getting a big refund. So I guess there's merits in not doing a variation, because you can sort of treat that tax refund as a savings. It's like you're forcing yourself to save that money, get the refund later.
Well, it depends on your strategy.
Depends on the strategy.
So let's break that down again for people that didn't follow that, right? Basically, it means if you're used to getting a $10,000 tax refund at the end of the year, let's break it down. You get paid weekly. You're going to get an extra $200 a week in your pay on top of what you already have. Right, so you're going to clear an extra $200 a week if you put this variation through. Now, Sam, how do these employees start this variation if they want to do it? Do they have to speak to someone like you? Do they speak to their employer? What do they do?
What do they do? How you go about it? Really, you can go direct to the ATO. So all you need to do, there's some links on the ATO website. You complete a form, digital form. It's all PDF stuff. There's quite a bit of details, so if you're time poor or you're concerned or worried and you don't know what you're doing, maybe you can stuff it up. I had a client actually stuff it up. So maybe if you get someone else to do it, if you're not good with numbers.
Someone like their accountant?
Their accountant, so I do them all the time.
Yep.
So if you have an accountant or you need someone to help you, an accountant will definitely help you. And it's merely lodging an electronic form to the ATO. Mm-hmm. What will happen, you can even see the loss that you're projecting. You won't get the tax rate, but you'll see 100 grand reduced to 80, and it's going to give you a certificate posted in the mail once they've processed it, and you give that to your payroll. The payroll guy will then withhold whatever tax is necessary for that adjusted income. That's it. It's very simple. Very simple. So if anyone is experiencing cash flow issues, holding property, or even just wants that extra bit of money throughout the year instead of waiting so long, because time is money. Time is money. So instead of waiting a year, I'd rather have that money in my back pocket now. So
all of a sudden, tax now is not that boring, right? Like if you're talking about a $10,000 refund, on a weekly basis, you're going to get an extra $200 a week in your pocket, right?
It's like a pay rise.
It's like a pay rise, right?
It is yours, but
think about it. For our listeners, what would you do with an extra $200 in your bank account every week? Like that could be, you could go out to a fancy restaurant with that. You could get another pair of shoes. Like that's once a week. Like now all of a sudden tax becomes exciting because we're like, okay, we've come up with strategies to really, really draw it back in, right? And this is on a weekly basis, right? You could put it towards savings or whatever your strategy is. It just means more money in your pocket. And that's what we want to do for you guys. Get more money in your pocket. Enough goes to the government. And they don't even know what to do with it.
They waste it.
They waste it, right? Like you don't get.
Or they fly helicopters to lunches, mate.
Oh man, they waste your hard-earned money. So it's up to you to take control of the taxes that you're paying and really, really try and get as much back as you can.
Tax is a game. The way I see it, tax is a game, and you're a player in the game, and you want to try and win as much as you can. So really, it's a big expense, like we said, and it would be very naive of you not to treat it with importance, because they are taking 30% of your income roughly each year, and if you add that up over time, that's a lot of money. That's a lot of money. So if you haven't had someone talk to you about tax or look at your tax affairs, I think it's very important too.
And what we're talking about here, the government actually doesn't want us to talk about this, right? Because they want you guys to go to work, pay your whatever it is, 30 grand in tax, 40 grand in tax, and make no claims. Oh, yeah. Because that means that they just get all of that money.
That's why they reduced all the claims.
And this is the reason why when you go to school, you're not taught how to do the tax return, because the school is the education in school is to teach you to become a robot so you become a taxpayer, right? And this is why you need unconventional self-education, like listening to this podcast, to be able to go, hang on a second, this is what we've been taught to do all of our lives. We need to start making a change. Take control of the taxes that you're paying and start getting some of that back. What are some other strategies that our listeners can sort of deploy to be able to sort of really get some good chunks back, Sam?
Yes, like I said, going back to workers, it's very limited. It's very limited, and they have really just pushed employees into boosting their super and investing in pretty much negatively geared either property or financial assets. So if you're looking to really get a lot of money back, if you're in a high tax bracket, even if you're in 100 grand and a worker, really your only options are going to super, which is a good thing, and you can maybe utilize your own super to invest and manage yourself down the track, or invest in property or geared financial products. So it's all about, okay, the only way you get more tax back is by claiming an expense, right? Spending money to get a tax refund isn't always the best thing. So like economically, it makes no sense. Spending $100 to get a 30% tax refund doesn't make sense. You're losing $70, right?
It's not an effective wealth building strategy.
No, not at all. You're spending money to save 30%. So really, when it comes down to it, and if you have a mind or an objective to try and grow, like we were always talking about, property and specific types of property where you can potentially get a cash neutral property whereby depreciation creates a loss. So you're not spending any of your own money to hold the property because it's cash neutral, and we can get into this at later stages and do videos about it. That depreciation will create the loss. So
what is depreciation? What is depreciation, Sam?
All right. So depreciation is pretty much a decline in value, right? So as we've talked about Mercedes-Benz, they depreciate in value, right? As do all cars. Depreciation is pretty much you buy something for $100 and over time it's the expectation that it's going to decline and have a lower value, right? And when it comes to property, what that means is that even though it's quite funny, even though property appreciates in value, what the ATO allows is a claim of a decline in value given wear and tear on the building. So if you're buying a brand new property, there's going to be pretty much the whole cost of that property to build is able to be claimed as a tax deduction and potential tax refund for you for every dollar of cost of that building. Massive claims,
so let's break that down. When you buy a property, you're buying two things, the land and the building, right? Now the land appreciates over time. We already know that, right? However, the building depreciates, right? So what we want to do is we want to make sure that the land basically overtakes that depreciation of that building, and essentially our property goes up in value. However, that depreciation of the build, so if we build a brand new property, like so before, we were talking about a $1 million property. Let's say it's a 5-bedroom home. So massive depreciation on a 5-bedroom home. You've got about $40,000 worth of depreciation in the first year, right? Now, if we buy in a well-located area, the land will appreciate in value and then we'll overtake that depreciation. However, we want to take that tax break. So that $40,000 tax break in the first year is what we want, and that loss. So let's say the building's worth 500 grand. Now, by the second year, it's probably worth 460 to the tax department's eyes, right? So what happens is that we're able to take that $40,000 gap as a loss of income. Now that's a perfect strategy for an employee, right? So that's why we say don't just buy one property, buy 1, 2, 3, 4, 5, so you get the depreciation on every single one to the point where your taxable income is at zero. And that is exactly how the rich don't pay any tax.
Yeah.
And so many people are spending their hard-earned money on consumable items like cars, jewelry, fashion, holidays, things that they're not going to get any breaks for. But if you go out and buy investment properties that are, that can be depreciated, and also all the expenses that come along with it, man, like it's such a tax-effective strategy.
And I guess what you can do is utilize those first few properties, if you're an employee, which most of us will be, in a negatively geared strategy, right? So if you get the 2, 3, 4 properties, you're going to have no tax. And then you can venture into different types of investment properties, which like highly positively geared properties, like dual key, duplexes, things like that, that actually going to make you cash money. Maybe not as much depreciation, but you're going to make a lot more money. Or maybe more depreciation.
Dual keys or duplexes, you're getting double depreciation, right? 2 sets of kitchens, 2 sets of bathrooms, 2 sets of fixtures, everything. So, like something can go from a $20,000 depreciation to a $40,000 depreciation model very, very quickly.
Okay.
But you're right, Sam, there are different types of investments that give you a lot more tax breaks than the others. And look, you wouldn't just invest in property purely for tax breaks. I treat it as a bonus. Like, I think investing in property is great. It's the best way to build wealth, right? That's what I've done. But at the same time, if you can save some tax, why not? Why not choose some properties that not only build wealth, but give you those tax breaks so you can get some of that money back?
Yeah, I've always had a lot of clients come to me asking about a property advice, which I'll refer to you. But my general point to them is that you're not buying the property for the tax break. You're buying it to grow. You're not buying it to try and sort of get more tax back. That's not the objective. It's to grow get capital growth and expand the wealth of you, and in conjunction get some tax breaks. So if you can get the two, which you're able to provide clients, you're laughing.
That's right. So like a lot of people I find in our industry, they count the depreciation and tax breaks in their cash flow analysis when they're looking at a property. And I believe that what you should do is focus on the cash flow analysis without it, and then it's a bonus when you get it, right? Because it's not guaranteed, right? But it can really propel you forward, because essentially we're talking about putting more money in your pocket, right? And that's basically what we want to do. We want you guys to give less to the ATO, because look, at the end of the day, yes, you've got to pay some sort of tax. Like we're not against paying tax, and we're not against giving the government any money or anything like that, but we are pro trying to get you your money back, right? Because you guys work so hard, and now with all this stimulus getting printed and the government handing out to the people that don't have jobs, who's essentially going to be paying for this, Sam?
Us.
Exactly right. So it's up to us to try and claw back as much as we can.
And going back to what I said at the beginning, there's a lot more taxes out there that we're paying that people don't realize. So trying to minimize your income tax, people sometimes look dirty upon people not trying to pay so much tax, but income tax is just one component of a lot of taxes that we're actually paying to the ATO, right? GST and all these other ones go to the ATO. So why not take control of your own affairs where you're able to, because it's a self-assessed system, and try to get back as much as you can? It makes sense.
Now, this has all been good. Up until now, we've talked about how do we, basically pay minimal taxes. How do we get more refunds? How do we get more money in our pockets? I'm going to flip it on its head now and talk about my situation. I actually want to pay more tax. Why would I want to pay more tax, Sam? Why do I enjoy paying more tax?
Well, paying tax means you're doing well. So you're doing well. You're probably doing well. Is that right?
I'm doing real good. I'm doing real good.
Okay, as well as being a mark of doing well, so if anyone comes to me with a big tax issue, I know they're kicking ass, right? Along with that is that it means you're making a lot of income. It means you can borrow a lot more money, and you can grow even further. So is that what you're alluding to?
Yeah, so we're gone from the fixed mindset of trying to get as much back as possible, and we're sort of contracting, right? We're trying to just get as much back as we can, which we have already made. But I'm now moving into the phase of, okay, the growth mindset of going, okay, we want to grow our wealth, and we actually don't care how much our tax bill is, because we know that the bigger our tax bill, the bigger our wealth is going to be.
Correct.
So for example, a lot of people don't like to pay land tax, right? You've got these different thresholds in each state. Now, I love paying land tax. Now, because if I'm paying big bills in land tax, that means the land value that in my holdings is through the roof, meaning that my net worth has really grown. So you guys who are listening, if you don't have a land tax bill, you've got to get moving. Buy more property.
Your value has to keep going up.
Yeah, you got to keep going, right? Because if the bigger your tax bill, it means that you're making money.
It's like a juggling act. I had a client situation where he was in business and sole trader, so nothing too complicated. And he wanted to get a loan for a house. So this sort of touches on what you're talking about. And being his own business, he has the ability to, say, include or exclude certain expenses to make his income level change, right? So he was going for a loan, and he had an idea to reduce his tax, but by doing so, reducing his income, he couldn't get the loan. So I had to work with him and maybe pay a bit more tax and realize more income to be able to get that loan to buy that property for it to grow. So it's a juggling act, and when you have people that can help you work it out, it can be very effective.
And this is the benefits of being a business owner, right? You've got the ability to go and increase your figures by paying more tax, and the government loves it. The government loves it because you're actually paying more tax, right? But then what happens is the banks also love it because they are willing to they'll lend you more money because they know that you've got the ability to pay those tax bills. So they're like, well, we'll give you $1 million, $2 million, $3 million. And now for me, I'm at a point where I'll pay the bill. I'll pay even more tax. Every year, my tax bill goes up because I'm trying to obtain more finance so I can go and do more deals, right? Because I want to control as much debt as I can. Like, give it to me, right? A lot of people are scared of debt, and this is a separate podcast to talk about debt, right? But I love debt because debt is what? Tax-free, right? So if I use after-tax dollars that I've went out to the marketplace and earned to buy investments, I'm working really, really hard for that. But if I use debt, if I use the bank's money...
Especially when it's cheap. So cheap.
And we're paying 2%. It's free money. It's free money. So if I can get as much debt as I can, and obviously I know what I'm doing, right, with property. I've been doing it for 12 years. I know how to invest in property. I know how to develop property. I know how to make money. So for me, controlling as much debt as possible makes sense, right? So getting back to tax... Because my tax bills are so big, banks are willing to give me the money, right? So every year I'm trying to actually pay more tax. I don't want to, claim all of these deductions to reduce my taxable income.
You want to show more so you can grow more.
I want to show more so I can grow more. And that's the growth mindset.
It's coming back to mindset we're talking about. So you have a really positive attitude and you're playing it like a game, which a lot of people don't. They see tax as like a problem or negative or something. But really, when you drill down into it, if you want to do certain things and grow, it can get relatively exciting, right? And you're able to do...
Well, I've never seen you so excited, Sam. Talking about tax. This is really your thing. You love it.
It is.
But these are the conversations that we always have, right? How do we creatively sort of pay a little less tax, but also grow at the same time? Like you said, it's a juggling act. Like in order to grow, like you've got to pay the tax. So like we're not advising people to go and pay huge amounts of tax and then not do anything. Utilize it, right? Utilize those tax returns to move forward. That's why even for the employees that are only on 100 grand, well, not only, 100 grand's a lot of money, right? So you're on 100 grand, you're paying 30 grand in tax. The banks are going to give you a certain amount of money, right? Utilize it. Don't go out and buy depreciating assets like cars and going on holidays and all of that sort of thing. Use that tax return to control as much debt as you can and then attach that debt to real estate that cash flows and pays you and gives you the tax breaks. It's a winning formula, but not many people do it.
It'll get your income from that say net 80 grand to the 100. So you're realizing your full income. So there are strategies to do it. So a lot of people may be too scared. If you're too scared, don't be. Come back. There'll be a link or something at the on the podcast that you can click and contact us if you want help. But that's what we're here for.
So guys, if you guys want help getting your tax returns done, or coming up with tax minimization strategies, or even how to grow, right? Come and talk to us. Give us a call, because Sam, an expert on tax, me, an expert on wealth creation through property investing. We're both qualified to do so, and that's why we do these podcasts, because these podcasts provide you the education that you require to really sort of, I guess, make a decision to take control of your future, right? And if you want to drill into it further, then come and see us.
Yeah, we're happy to chat. Even a phone call, we can meet up, anything like that. So we're in the business of helping people and sharing knowledge. So if there's any people out there that want to talk about their situations, we're more than happy to.
So we're in the business of trying to make people more money. That's plain and simple. We want to make more money. In order to make more money, you're going to have to save more money, and then you're also going to have to spend more money. Like, this is the thing. A lot of people they focus on saving. I don't like it how people just save. What are you saving for?
It's not doing any good for you. Right?
What are you going to do with it?
What's the interest rate right now? It's not giving you good return.
If you've got money in the bank, what's it paying you? 1%?
Less than.
What's the inflation rate at?
2 point something.
And do we predict it to be more over the next, say, 10 years?
I think with all the stimulus, yes.
So we are now in a low interest rate environment, high inflation environment, or going to be. We are in a different era. Like our mum and dad, for example, they put money in the bank. It was actually doing something.
7%, 8%.
Right? Now it's all about, okay, put it into something like bricks and mortar that hedges against inflation, but also appreciates in value over time, right? We now need to move our money. We cannot keep it in our pockets. We can't keep it in the bank anymore, doing nothing. I call it the velocity of money. It needs to move.
Oh, I've never heard that before.
Wow, velocity of money. That's my thing, right? Speed is the
So
new
it has
currency.
to keep moving.
Yeah, it has to keep moving. Move your money. Put
it can't
to
be
work.
in cash form, right? You have enough to get you through, but no massive savings. It has to be utilized.
Save money to be used. Save money to invest. Don't save money for the sake of it, for saving money, right? Like, for example, every day I'm thinking about where I can put my money and put it to work. Like, for example, we're paying for this podcast.
Do you get upset if you have too much money in your bank account?
100%. I hate having a lot of money in my bank account. Right? Like, as soon as I get to a certain figure in my bank account, I exhaust those funds. I get rid of it. I push it into an asset to make it work harder for me. I send it out the door and go, bring me back 2, bring me back 3, right, per dollar. Now, as soon as I exhaust those funds, all of a sudden I've got to go out to the marketplace and make more money, pay more tax, right? And what that does, it just forces you to grow, right? It grows. And also, all of those funds that are out the door are working extra hard for me, and it's going to come back. It's going to come back, and it's almost like it's going to multiply outside and then come back and bring me more, and then I'll push it back out again. This is not something that was done 20, 30, 40 years ago. This needs to be done now, because if you've got money in the bank, you're losing.
Oh yeah, right now the environment, 100%. You're touching on a good point where in order to grow, and I think coming from an accounting background, I see this a lot, especially in accounting firms, different accounting firms. They want to grow, but they don't want to spend the money to grow. So if you're not going to spend money like you do, you're spending money everywhere, putting the money back out there to work, you're not going to grow. So a lot of people are very scared and save their money, but they're unwilling to depart with it. But if you don't, you're not going to buy that property, you're not going to invest in that business, invest in yourself, you're not going to have the ability to grow. So I think you're touching on a very good point there.
Let's just not confuse ourselves with spending money, right, and with wasting money. Because a lot of people think, okay, if I spend money, I'm wasting money. You're actually investing money. What we want to do is we want to push that money to work, right? And we're investing it in things to make money. And as I was saying before, like this podcast, for example, it's costing us money to do this podcast, but it's an investment. It's an investment into our brand, It's investment into our business. It's an investment into our audience, right? So it's actually going to return us. Might not be a monetary value, but it might be exposure. It might be people getting to know us a little bit better, right? So there's a return on investment. So we're happy to spend that money. So, you know, or invest that money, right? So it's going to get a return. But it's really important to have that money moving around.
Yeah. Whenever you're looking at spending the money, just try and see, you know, there's going to be expenses in your life that are expenses, right? Everyone has some food and all these kinds of things, daily expenses. But if you're going for more substantial costs, maybe just look at them and say, is there something going to come back to me? Is there a return on this money? Not everything. You don't want to get to that kind of dry, boring level of life, but really use your money very wisely. You only get a finite amount of it. So try and use it as best you can.
And I love that. Use your money wisely. You get a certain amount each week. You get a certain amount each month. Do smart things with it. And one thing that I want to finish off with, like a really, really good tip, is to tax yourself first.
Explain that.
Right? So tax yourself first means pay yourself first. So if you make, say, $1,000 a week, put aside $300, take that and put it into a sacred account. So that's for investments. That's purely for investments, right? Do that before you pay your bills. Do that before you pay your rent, before you eat, right? If you get to your 5th or 6th day, you've got no food left, then don't eat. Fast. Do a 48-hour fast. It'll be good for your pocket. It'll be good for your bank account, right?
100%.
So tax yourself first, just like paying yourself first is really important. So the government does it, so you should do it to yourself.
Fundamentals is very important.
Fundamentals, key word.
That's it.
All right, guys, that's it for another podcast. Thanks for listening. We will see you in another couple of weeks. Peace out.
See you guys.